Welcome, everybody. Thank you for taking a part of your day to join me for a webinar on real planning for real people. We're just going to wait a couple more minutes for more people to join us. But in the meantime, Josh, would you share that quick poll with the listeners, please? No, I don't see the poll. Josh, can I see it as well? Oh, there we go. So thank you so much. So the question I want to pose to you may feel like it's unrelated to finance, but the question I want to pose to you today is, if you were invited to a dinner party and you were offered dessert and you were offered either, a delicious plate of fruit, ripe, juicy fruit, or the most decadent cake you can think of. For my husband, that might be a strawberry shortcake, or for me, it would be, a multi-layer fudgy kind of something delicious. Whatever it would be, if you were offered the choice between fruit or cake, choose one and please be honest, because we're going to be revisiting this as we talk about decision making as it relates to your personal finance, which is the topic we're going to be talking about today. So again, for anyone who joined us more recently, the question is, if you were invited out to dinner or at a dinner party and you were offered dessert, if it were either fruit or your favorite decadent dessert, would you choose fruit or cake? And again, please be honest. We'll just wait a couple more seconds for more responses. Funny, while we're waiting, don't know if anyone is a CBC listener, but there's a very funny episode of The Debaters, which is a program where comedians debate topics. And there's a very funny episode that I actually saw being taped live on what is better, cake or pie. And I won't ruin it for you, but it is hilarious. And of course, I'm sure you can find that online. Okay, so how about we close the um, the poll and let's see those responses. Okay, so Josh, what are those responses then? As we go back to the webinar then. Josh, can you tell me in the chat what the responses were? Aha, 53% say that they would choose fruit and 40% would say that they would choose cake. And we'll revisit this question in a minute. So let's get back to the task at hand. Thank you for indulging me, my silliness. This webinar is going to be recorded as all others are, and it will be made available on the UPotential website. You'll be able to access it through a thank you email that'll come to you a little bit later on. And of course, please, you're always encouraged to send in your thoughts, your questions, suggestions for future webinars. I love to hear your suggestions. And of course, it looks as though today we will have a little bit of time for questions. So you can always send those in via the chat and I'll address them at the end of the webinar. Okay, so before we begin, I'd like to welcome those of you who may be new to UPotential and to my webinars and give you kind of a sense of my background. I've been in the financial services industry for, I hate to even say this, but about 20 years now. And my background really does vary. I have worked with the very financially vulnerable all the way up to people with very high net worth. And if I had to say, in my experience, who most benefits from our work together, Through hundreds of individuals and couples and families, I would have to say the people who get the most out of our work together are those who are facing some sort of decision in life, or at a crossroads. That decision could be, how to set up a budget, to create a baseline for your standard of living, or it could be, that very, very delicate balance between getting what you want from life today and providing for your future self and those around you. In either event, whether we're doing so for those who are managing just barely or those who have much, much more than they can spend, the context that we provide in our planning is what allows you to proceed with confidence that your decisions have been made, with consideration in mind. Professionally, I'm the head of financial life strategies for both Potential and ETF Capital Management. UPotential is the fee-for-service financial planning firm which provides unbiased advice and strategies to Canadians. I'm also incredibly grateful to be working with the clients of ETF Capital Management as part of their suite of client services. But rest assured, whether you're working with ETF as your portfolio manager or doing it yourself or working with someone else, the advice is exactly the same. It's unbiased and it's focused on what you need, including, retirement planning, tax planning, and so on. So back to our polling question. Say again, you're offered the choice of a ripe, delicious plate of fruit for dessert or some sort of a decadent cake. You know, According to the poll, about 53% of you said that you would choose the fruit every time. And I can only hypothesize that that's probably because it's healthy. Others might say that they might choose the fruit, let's say most of the time, but might select the cake sometimes, let's say for various reasons. In our discussion, 47% of you said that you would choose the cake, and I got to tell you, I'm with you people because cake is my downfall. But why is this important? Well, it's important because the choice seems easy. Do I choose something healthy or unhealthy? But it really isn't that easy. And this type of a decision is something that we face every day, even in our financial planning. The choice that we make, let's say, in this relatively unimportant realm, choosing between cake and fruit, is influenced in large part by our mood. So let's say you might choose the cake because you need to buoy your mood after a bad day, or you want to reward yourself because you went through, a particularly grueling workout. Or maybe it's just somebody's birthday or anniversary and you think it's time to celebrate. Either way, a seemingly easy decision such as this is influenced by outside factors that are both positive and negative. Clearly, when we make decisions, we don't always do so in a way that's either objectively rational or even in our own best interests. So say instead you're faced with another choice. This is something a little bit more pertinent to our topic today. Whether to make a lump sum mortgage payment or to contribute to your RSP. Is that decision any simpler? Well, it's also dependent on your mood. If we looked completely objectively, some financial pundits might say that it would be better to, let's say, weigh your mortgage interest rate versus your marginal tax rate, which, for those of you who are unfamiliar with the term, a marginal tax rate is the rate at which your RSP is refunded to you. That might be, let's say, a rational response, but it might still not influence your actions. To some, carrying debt is so uncomfortable that they would prefer to be debt-free regardless of whether an RSP contribution would yield a better refund or not. Or another example, let's say you're facing a downsizing situation. You have a severance that you could either apply to a credit card balance, or you could squirrel the money away for yourself to support yourself while you look for work. Objectively, as a planner, I would counsel a client to set aside at least 3 to 6 months worth of expenses before considering any lump sum payment against a credit card. But the question isn't what I would tell you to do. The question is, what would you do? Whether it's because it feels irresponsible to sit on cash while you have a debt outstanding, or because you feel the need to be, let's say, debt free because that has been impressed upon you from a young age, it might feel better to repay the loan. But the question is, would you be better off 6 months from now if you haven't found work and you need to go back and accelerate and bring back those debt balances again because you need to borrow, because you have spent your emergency reserve? That's the kind of objective decision making that you might need to make that is not necessarily in line with your gut instinct. As a financial planner, or we refer to it as a financial life strategist at UPotential, we work a lot of the time helping clients to view a situation a little bit more objectively so that they can make better decisions. So we serve as a sounding board and try to provide objective calculations. Now, I'm not foolish. Sometimes our clients proceed with our recommendations and sometimes they don't. But either way, an objective perspective gives you a little bit of a different view of a situation so that at least you can proceed more confidently. And today we're going to spend some time talking about helping real people, you and me, make better, more constructive decisions on how to build wealth for your future. There's actually an entire field of research called behavioral economics that helps us understand how we make decisions and how to choose more constructively. In my job, I try to help clients optimize their strategies, and you might find that sometimes my advice is actually contrary to either what your gut or your sister-in-law, for that matter, is recommending. So today, we're going to look at ways to put a little bit of space between your gut instinct and your action. And it's this space where rational decision making lives. To do that, we're first going to look at factors that influence you. Then we're going to try to look at how you can make better decisions in investment markets. And finally, how to create a balance between what you want now and what your future self will thank you for. I've recently been introduced to some new software created by Quintessence Wealth that helps clients to identify their values. For those of you who are unfamiliar, Quintessence Wealth is the umbrella organization under which both UPotential and ETF Capital Management serve. Now, why the focus on values? Well, unlike goals that can often be reset to loftier and loftier ideals, and are much harder to satisfy, values are really fundamental. So for example, when I started in the financial planning industry, the uh, the focus was really on telling people how to be very specific on what they want out of life rather than just saying, I want to live comfortably. Well, that sounds great, but when we quantify that and encourage people to quantify that, they might say instead, I want to be able to live on $50,000 a year after tax. That's great. That's a goal. But no one would deny that 60,000 isn't a better goal, right? Or would give you a better standard of living. So the question is, if you're focusing on goals, 50,000, 60,000, 70,000, you can always do better. But if you focus instead on values, those are so fundamental to your character that they become much more consistent with pursuing and achieving true life satisfaction. And that's what this tool has taught me a little bit about. So the exercise that I went through had me identify and then whittle down my highest priorities. Now, the key to this was that I was making these determinations with no consideration in mind. I wasn't in a stressed state. I had a cool, calm mind, and I wasn't concerned about whether those ideals were affordable, whether markets would cooperate with them. I wasn't concerned about taxes or, obligations to my family. Simply, what brings me the greatest satisfaction in life. Once that's established, I can then measure any situation that I'm faced with relative to these values. Any strategy that I want to impose, if it brings me closer to those outcomes, then I can pursue it. If it brings me further away from those outcomes, I know to walk away. What I learned from this exercise personally was that my top 5 values are relationships, abundance, health, generosity, and creativity. And then what I did in the exercise was I spent some time defining what those mean to me, as well as what it would look like to achieve them, as well as, a little bit of thought to, you know, which is an uncomfortable space to be, by the way. I had to give thought to what's preventing me from pursuing these things. Now, we're not going to delve into those pieces right now, but this is the exercise I went through, and I have to say I found it very enlightening. So with that in mind, sorry about that. With that in mind, then I can look to whether an objective is bringing me closer to those values or further away from those values. Let me give you an example. My husband and I are servicing, thank goodness, what is relatively modest by way of a mortgage. In fact, we could really repay it at this point. The question is, should I? What else would we do with that money? Well, we're thinking perhaps we might take a trip if, the borders open up and we're allowed to. If I listen to my gut, I'm not going to lie to you, I would full on repay that mortgage because I really cannot stand the obligation. I hate the biweekly withdrawals from our account, and I can only imagine how freeing it would feel to be mortgage free. And I also won't lie to you, prioritizing a trip does feel like it's financially irresponsible, and it does not sit well with me. So I thought, okay, let's try it. I've done this QLife exercise. Let's see if it works for me. So if I look at my values, surprisingly enough, none of my values relate to finances, which is hysterical because I live and breathe financial planning. The value that most closely is associated with the question of whether to pay down my mortgage or take a trip is abundance. The idea that if I paid down the mortgage, perhaps I would have more discretionary income to do with as I please. But look at that. It's only third on my list of priorities. The other thing to keep in mind, and something my wonderful, rational husband reminds me of all the time, at this stage of our amortization schedule, we're paying very, very little in the way of interest. So repaying the mortgage won't even improve my abundance by any, consequential amount. So objectively and somewhat surprisingly, my values would have us take a trip this year. So what did we do? We actually put a deposit on a trip, and our fingers are crossed that we'll still be able to go. But it was a very surprising way to apply this values exercise, and something I would certainly encourage everyone to do. So let's now turn our attention on how real people make investment decisions and how we can improve the habits that let us build on our wealth accumulation. So, suffice it to say that our futures depend on our ability to save enough to cover our lifestyle when we stop working. But savings isn't enough. We actually need to invest to both keep pace with inflation and sometimes to make up for time, let's say that we couldn't save as much because our earnings were lower or we were raising families or paying down mortgages or perhaps we had other priorities. And so what investing does is it kind of gives us that accelerant, the gas in the tank that makes up for lost time. The problem being that most people are not successful investors. And those that are successful don't do so consistently. And those that, let's say, are consistent don't usually beat inflation. So what's a person to do? We take an example from those who are successful investors, and the most successful investors are those with a long time horizon who can observe the portfolio and look at markets dispassionately. And that's part of the reason that investment committees of, let's say, the largest pension funds and so on, those are some of the most successful investors. Interestingly, I don't know if you listened, but I actually made an appearance on Larry Berman, who you might know from Berman's call on Business News Network. He does a series called Investor's Guide to Thriving, and I was on his program about a week ago, and he was explaining the incredible success, for example, of the Canada Pension Plan Investment Board. So that's the committee that runs the CPP that we all will eventually receive a little bit of income from. Now, according to Larry, they invest successfully, and in part that's because they have access to some investments that individual investors like you and I don't have access to. But apart from that, they're also thinking really long term. I mean, generationally. And in thinking in that way, they're not reacting to minor changes in markets like you and I might. So most people would be better served for that reason, delegating their investment responsibilities to a discretionary money manager. So for those of you who invest with ETF Capital Management, for example, that would be Larry and Josh, because they can think longer term, review the markets more objectively, and encourage us to kind of stay out of our own way. Now, if I had my way, no one would be able to brag about a stock's performance without disclosing their entire portfolio. You want to brag to me? I want to see your stinkers also. So if you can keep in mind that most people's anecdotal description of their investments is somewhat curated, and we all criticize social media for being curated. Well, keep that in mind when people are talking about their investment portfolios as well. What that type of curated performance information does is it makes the rest of us feel like we're not achieving the best returns and has us really, chasing what is otherwise an unattainable performance goal. You want to talk about fear of missing out? There is no greater example of FOMO than people who are talking anecdotally about the investments that they missed out on. We'd all agree that we'd have done well if we knew exactly when to buy Apple and exactly when to sell Nortel. So instead of choosing asset classes or markets or sectors or even good individual companies based on their performance, many of us try to time the markets. We'd all love to buy during a market decline and sell during a market boom. Now, the problem is that the bottom of a market is only visible in hindsight. So if you ask me, has the market bottomed out? I can't tell you. I can tell you 3 months from now, but I can't tell you today, and nobody can. The problem is that while we wait, our money typically is not doing anything for us. And again, it's the emotion of not wanting to buy at a high that has us idling on the highway's shoulder. Research has shown that it's better to stay invested and rebalance your portfolio to a target asset allocation or rebalance when a certain concentration of your investment has become too high, regardless of what the markets are doing, simply because the math gives us that objective kind of long-term perspective that each of us lacks in the moment. I, for one, know that I simply do not have the time and I don't have the courage to make investment decisions on my own. But I do really enjoy having some influence on my investment portfolio. And I do that by controlling my contributions rather than the investments themselves. So, for example, it's not uncommon for different investment account types, your RSP versus your TFSA, for example, to have different investment philosophies. Many people, for example, will invest more aggressively in their TFSAs. And some of them do that because they don't have to worry about the capital gains. You don't pay any tax on any investment um, income that happens within the account. But it's also in part because those who actually contribute to TFSAs typically have a higher net worth than others and probably do not need the money as urgently. In contrast, many people tend to hold fixed income investments, GICs and mutual funds that hold bonds, for example, in their RSPs. And there's good reason for that, certainly, because there's no tax benefit to holding anything that's tax efficient in your RSP. So for those, I'll often counsel the client to say, make their contribution strategic rather than focusing too much on what individual investments are held either in the TFSA or the RSP. Simply decide that if, let's say, you want to contribute to equity markets while the market is low, you put your money into the TFSA and have your discretionary money manager apply the money to whatever sector, economy, um, individual investment, whatever they see fit. Your choice happens in whether to direct the money to the equity allocation of your portfolio via the TFSA in this example, or the fixed income portion of your portfolio via the RSP in this example. Focusing on the contributions rather than the individual holdings, again, promotes the kind of dispassionate view of your portfolio that you need to have investment success. Let's say that's not enough control for you. You want to do more. Why not manage a 5-year laddered GIC portfolio? For those who are not accustomed to that term, um, a GIC portfolio is one where you buy, let's say you segregate the amount of money that you want to invest in 5 different GICs with varying maturity dates. So let's say you have $100,000 to invest, you buy 5 GICs at $20,000 each, with one having a maturity 1 year from now, 2 years from now, 3 years from now, and so on. The elegance of this strategy is that you are forced, as each GIC matures, to look again at the proportion of fixed income and equities in your portfolio. It almost reminds you to take a look at your portfolio every year. And when you're making that decision, the decision you really need to make is, do I need the money today? And if I don't need the money, do I still want it to be in fixed income? If I want it to be in fixed income, you buy another 5-year GIC. In most cases, the longer commitment, the 4 and 5-year GICs, would produce a slightly better interest rate. Unfortunately, interest rates stink right now. So if you're going to implement something like this, be prepared to lose money relative to inflation. Lastly, I want to turn our attention to how real people make investment decisions and how we can improve those wealth accumulation habits. Financial planning influences a whole other pile of ideas in your in your life. So your financial plan will influence your investing, your insurance needs, your tax strategies, and a whole lot of other areas. Yes, we will discuss the standard of living that your income and wealth can support. Some people may want to call that budgeting, but it really is so much more. One of the things that's so critical about financial planning as it relates to investments is that we can determine the rate of return that you will need to achieve your goals, and at the same time look at ways to both optimize the income that you earn, minimize the taxes that you pay, and actually free up the money that you need to invest. Having a financial planner who's divorced from the product sales actually is the gold standard when it comes to financial services. Advisors and portfolio managers will tell you that one of the most important services that they provide is a sounding board that helps clients resist the temptation to sell during a down market. Just think back to about a year ago when markets were losing constantly. We couldn't see the forest for the trees. We could not appreciate that anything would ever improve. There were, lines for to get into a bank because of fears of COVID, and everywhere you looked, you had to wait in line to go to a grocery store. It really was an unfathomable situation, and markets reflected that. It would be completely understandable that you'd want to get out of the market when you see that kind of a free fall. But we need to resist the temptation and stay invested if we want to avoid selling at a low. And so much of the value that your financial team does is in providing that perspective on your portfolio and not letting emotions make you make destructive decisions. To optimize your return and enjoy as much of the wealth as you can, you also have to understand that your portfolio's return is just one aspect of the wealth management process. In many ways, the tax strategies, contributions and tax effective drawing down of your assets in retirement, as well as estate planning, those can be as important, if not more important, than your annual investment return. In most cases, investment advisors will start your relationship with a really lengthy discussion about, um, how much risk you want to take, and essentially, it's a process called a know your client process that comes to um, distills your attitudes to your risk tolerance. If you ask me, it's entirely backwards. If you focus on the risk required to achieve your plan, and by the way, you may find that you don't need to take as much risk as you need, then you can really determine the kind of investments that are suitable for your values and ultimately to achieve your retirement. Higher risk certainly will, and over the long term, mean higher returns, but lower risk can often mean a more consistent return. So the plan will help you determine the risk required. Once the risk required is determined, then you should know your risk capacity. And the risk capacity is the extent to which your plans would be derailed in, the inevitable market pullbacks, a pandemic, the financial crisis of 2008 and 9, all sorts of things. If you're incredibly vulnerable during those periods of time, you simply cannot take as much risk as if you have factored in certain protections in case of market softness. So for example, if you have the time, you're a good number of years before retirement, and you have the accumulated wealth, well, yeah, you have a pretty good capacity for risk. But if you're nearing retirement and you haven't yet built up wealth, well, you have a very low capacity for risk, and that could spell disaster in case of a market tumble. So once we've determined the risk that's required to get you where you need to go, and we've built in some capacity for you to create that distance between a market tumble and the need to sell right away, only then should we be looking at the amount of risk that you want to take, or what's otherwise referred to as your risk tolerance. For example, are you a conservative person by nature? Or are you, in other words, comfortable with the ebbs and flows of markets? Until we need to know the risk or investment return that you need, and we've created the capacity, we simply cannot let your gut instinct make the decision for you. What this exercise allows us to do then is to distance ourselves from the wealth accumulation process. Let's say you've determined that you need a 4.5% rate of return on your investments and markets go down. Well, what you can do then is you can look to the performance of the portfolio since its inception. Don't look at what the markets today are doing. Look at since the inception of the portfolio, are you at or close to 4.5%? If that satisfies your goal despite the market downturn, you don't need to bat an eyelash. Or at the very least, invest the money that you will need to fund your retirement in a manner that's consistent with your risk required. So let's say you want to buy something on your brother-in-law's advice, or you hear that pot stocks are hot, or tech stocks are hot. Fine, go ahead, but do that in a separate, some sort of discount investment account that isn't directly tied to your financial future. That way, your financial future is never at risk. If you hit it out of the park and you do great with that investment, super, go on a trip. But don't let those decisions, the hot stock or the trend, don't let that influence your long-term financial vulnerability and stability. To enable yourself to build wealth without sacrificing what you want, you have to start early. And starting early in any major city in Canada might simply mean paying a mortgage religiously. Believe it or not, that helps tremendously in two ways. One, of course, you're building up equity, and that's what most people will think of. But from my perspective, paying off a mortgage every month, what that does is it makes you accept a standard of living that's a little bit less because of the costs of maintaining the mortgage. In many ways, servicing the mortgage is actually a great forced savings tool because it forces you to spend less on other things. And we all know that the standard of living that we establish is the one that you're going to want to defend. Lifestyle creep, which is kind of the notion that as our incomes go up, so too is the lifestyle we want to live. That tends to affect the standard of living that we want to defend. And what happens then is, as we do allow ourselves creature comforts and maybe a nicer lifestyle over time, that translates into more and more capital that we need to save and invest in order to support that standard of living down the line. And please, if you take one thing away from this seminar today, please understand that we would all love to see an 8 or 12% annual return, but no one gets that consistently. Let's say you've enjoyed one or two, enjoy them for the unicorn that they are, and focus on the return on investment that is needed to get you where you want to go, which is ultimately living your values. So before I take questions, let's just look briefly at a summary of our discussion today. First of all, no disrespect intended, but we're all human, irrational beings. We're emotional beings. And emotions, and more precisely our values, really should drive our behavior. Using our values as our beacons instead of a set goal that we know could just become loftier and loftier will help us make better decisions that ultimately will benefit us. Secondly, emotions influence our investing. So we need to work with someone who can serve as that sounding board and help us prevent ourselves from making bad decisions. Our guts can tell us only that we're nervous about something, but it's analysis and context that will show us whether we're truly vulnerable or if we should just stay the course and continue being invested. And finally, financial planning is really more than just budgeting, but it's really understanding the standard of living that you can support, which is the first step in creating a plan that you continue to enjoy for life. I heard it said once that you create a lifestyle that you can support so that you can support the lifestyle you create. And I think that's really well said. Before I take any questions then, just want to let you know it's actually later this month, but the next webinar is going to be on November 30th. And we're going to be discussing some best practices when it comes to year-end planning, including planning for your holidays. So I'm going to ask now Josh to share with me any questions that came up. And again, if you have a moment, please submit them. All right, the first question I have here is, relative to a recent appearance I made on Larry's program, The Investor's Guide to Thrive. So the question was, there was a hint that inflation is going to be going up, and how could I protect myself from inflation? That is a very, very good question. So let's parse that out for a second. Part of the reason why the inflation numbers have been a little bit startling recently is that when it comes to inflation numbers, they're usually year over year. And when you think of what was happening a year ago, that isn't the greatest benchmark from which to draw a conclusion on inflation. The cost of goods and services a year ago was unusual because we really were in the throes of the pandemic and life was just starting to open up. We're a little bit further on now, and when we see costs going up now, we don't know what part of that is due to things like you know, restrictions in the availability of goods and services or the cost of goods and services, which would lend themselves to inflationary pressures, or how much of that is simply more people buying because of the seeming stability of financial services and our jobs right now. So let's first take a little bit of a grain of salt when it comes to the inflation numbers, but that's not that I mean that inflation is not going to rear its ugly head. I full on believe it will. So when it comes to preparing yourself in case of inflation in the future, you want first and foremost to focus on anything that is related to interest rates. If you have a variable mortgage, you want to watch that, not necessarily react to it, but you want to watch it carefully because a variable rate, if inflation does what we believe it to do, will mean that you'll be servicing a more expensive mortgage in the future. You want, for those of you who might have investment loans, that too will have an effect on the margin that you are paying for. The other things you're going to want to watch out for are things like fixed income investments. Again, the GICs and bonds. Forgive me, I'm just taking a little drink here. And those obviously will suffer if they're the kinds of bonds that have a secondary market. In other words, a GIC you buy and it matures and there's not much that you can do. You don't sell a GIC. But a bond, let's say related to a utility or a particular business, those you can trade just like you would trade a stock. And what happens in inflationary times when interest rates go up is that people will say, well, a new bond is going to come out with a higher interest rate. Why would I buy an older bond with a lower interest rate? So the actual value of the bond goes down. So you will want to watch your fixed income holdings carefully. With regards to the stock part of the portfolio, though, that's where there is a little bit of good news. And typically, inflation, when it does go up, and I mean real inflation, not just the year over year that I was cautioning you about before. When inflation does go up, that typically is a hint of a stronger economy, sort of usually the tail end of the economy. And interestingly enough, stocks tend to increase in value in lockstep with inflationary pressures. So, really, the portion of your portfolio that would be vulnerable to inflation is the fixed income portion, not the equity portion, or at least not to the same degree. So, thank you. That is a great, great question. I'm glad you submitted it. Another question is about my comment on repaying debts. Why would I suggest that people not repay a debt if they found themselves with a lump sum? Great question. Let me clarify. Repaying debt is always great. But when I'm referring to repaying debt with, let's say, the lump sum that I was talking about then was a severance payment, what I was trying to describe is using a lump sum that you might need to cover your own expenses while you're looking for work, keeping that, squirreling that away perhaps, rather than sending that to your credit card company to pay down your debt. And the reason I suggest that is because the lump sums that you get, we don't know when your next job is going to come. I would much rather you use any excess that you have of that severance once you have found a job. Then you can pay the outstanding balance on your credit card. But in the meantime, you're going to need that money. And some people will say, well, I'll repay my debt or my line of credit. I can always tap into it later. That's what I'm cautioning people against. And that's because it really does create a vicious cycle. People typically who are carrying credit card balances are already finding themselves perhaps without a balanced budget. They're spending slightly in excess of what their earnings or their wealth can support. So this really just creates a vicious cycle if you're constantly in a lump sum repayment and then you let the balance creep back up. So what I would prefer to see is maybe spending some time looking at the true affordability of what you're earning and creating a spending pattern that is realistic for what you're earning, and again, only repaying the loan once you have found work. So please don't misunderstand. Of course, I would like you to repay debt, but I also want you to, you know, have the money that you need to cover expenses while you're looking for work. Okay, next question. How can we ensure that we're aligning our spending with our values on seemingly small purchases that tend to add up? Things like lifestyle inflation, so eating out and coffee, trips, things like that. And again, that's such a great question. So first off, let me be clear. I do not concern myself with the small indulgences in life. I What I would prefer that you focus on is that measure of affordability of what your income can support. So, for example, if your income can support, let's say, $4,000 a month in expenses, it doesn't matter to me whether you spend that $4,000 on an adventure, on, a leased vehicle, eating out. It does not matter to me, provided that you don't exceed $4,000 a month. The problem becomes when the, quote unquote, kind of mindless spending, the coffee, the Uber, the whatever it might be, adds up and starts to exceed the level of affordability. So what I would rather people do is take a good long look at what they can afford. And incidentally, I have recorded a webinar on this. I think it's called New Year, New Plan, and you can find it on the UPotential website. It goes through an exercise that really shows you how you can determine what your income and wealth can support by way of a standard of living. And once you know that number, be it $4,000 or $2,500 or $9,000, Then what I would have you do is look at some sort of a basic budget. I have a spreadsheet I can share with you, and deliberately decide where you want to spend that money. So for example, if going and buying an expensive coffee once a day is the only break that you get during the day, then I think that's a worthwhile lifestyle enhancement. But you might need to give up something else. So when you look at the amount that you can afford, those price points I gave you, 2,500, 4,000, 9,000, whatever the price point is, and then you look at a budget and you decide deliberately where your money is best spent, then you can spend it any way you choose. I'll give you an example. I don't much, I don't have a great need to commute long distances. So for me, a brand new car every 3 years doesn't provide me a lot of value for my living. I would much prefer to, let's say, be able to eat out once a week. So I can choose deliberately. I'm happy driving a used car that's as long as it's reliable, but I want to make space in my budget for eating out. So giving up one thing allows me to do something else. If you can make that budget deliberately and in the doing so in a kind of a proactive way rather than a retroactive way, don't pull out 6 or 12 months worth of statements. That'll just make you crazy. Do so in a very deliberate manner going forward, so that you know, okay, you know what? I'm not going to feel bad about going for coffee once a day. I'm not going to feel bad about eating out once a week because this is what I've decided is the lifestyle enhancement that means the most to me. I think that's really the way to deal with lifestyle creep. Okay, we have another question here. In the case of a lump sum severance payment, is it permissible to request taxes deducted to be lowered if the lump sum payment is directed to one's RSP? Also a great question. So what we're talking about here is when, especially late in the year like we are now, late in the calendar year, if you were to lose your job or for that matter, get an unplanned bonus, for example, that's going to be taxed on top of nearly a full year's of income. And if you know anything about the Canadian tax system, you know that our tax system is one that's based on a marginal tax rate. The more you earn, the higher tax bracket you're in. And so what happens when you get a lump sum severance then, especially later in the year, let's say you're getting, 8 months worth of income and it's paid to you on December 31st, you're actually going to be taxed on 8 months of income on top of a full 12 months of income. And that's 20 months of income will undoubtedly move you into a higher tax bracket. So the question becomes, can you move some of that severance directly to your RSP? And the answer is, from a mechanical point of view, it depends on how your employer is structured. If your employer has the means to send your gross severance amount directly to your RSP, in other words, you can't touch the money, it cannot hit your bank account. If the money hits your bank account, then presumably they have to send it to you in net dollars with taxes already withheld at source. But if your employer is set up to be able to direct that payment directly to your financial institution, then yes, it might be possible. But the question is, again, should you do that? And the answer could be that, and I'll qualify this by saying, if it's towards the end of the year, you probably will want to direct it to your RSP, because in this case, even if your unemployment, presumably you're getting a severance because you're unemployed, if your unemployment is prolonged in the new year, once we hit January 1st or 2nd, whenever the banks reopen, you can withdraw from your RSP, but it's a fresh tax year. You have all new tax deductions, a new personal exemption, all sorts of things. So provided that you can straddle the year end, sure, put the money in the RSP and you won't have to worry too much about, running out because you could access the money come January 1st. If we look at it in a different measure, if we're, let's say, April 30th, and you lose your job and you put all your money into your RSP, well, you're going to inevitably have to take that money out if you don't find work. And so I don't know how much good you're doing in that particular case. So again, this is a situation where it's so idiosyncratic. What's best for you really is dependent on your prospects for work going forward to replace the job you've lost, the time of year, how much you're earning, whether you're eligible for the whatever employment insurance programs are available right now. There's so many variables. So great question. And if you want to talk about this personally, please, I'm going to give you my contact information right here. So again, thank you for joining me today. Please keep the questions coming. I'm happy to let them inspire future webinars. If I can be of any service, all my contact information through UPotential is available to you on this slide. And as I mentioned earlier, all the slides will be available once we get that thank you email sent to you. So again, thank you for your time today. And I wish you all the best and look forward to speaking with you again soon.